trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, welcome back, Market Rebels, and to all of our YouTubers out there. And Stu, I know that you have seen worse markets. I have too, but we've also seen a lot better. It wasn't a real pretty day today. I think we were down, maybe 1.5% or so on the SPY. I think maybe down 1% on the Dow. Not looking real pretty out there.
Yeah, a little under 2 on the Qs. But hey, we've seen this before, and we all know that over the big giant picture of life in the long term, markets have an upward bias.
Yeah, exactly. So we're not too worried about it yet, but we'll have to see. Jobless claims came in a lot lower than expected. I think about 201,000. They were looking for about 225. So that certainly didn't help after the Fed's announcements on Wednesday.
My friends
So anyway, what we wanted to do for everybody out there, we always try to bring you some interesting topics here on Coach's Corner to help you make better decisions and help you understand options and strategies better. And one of the things that I know Stu and I have always had a lot of great conversations about our favorite Wall Street movies. I mean, we've talked about Wolf of Wall Street, Big Short, and of course, everybody's favorite, Wall Street with Michael Douglas. And we always try to pick apart some of the trades or some of the inconsistencies, things like that in the movies, just for some fun conversations. And so we came upon one and we thought, you know what, this would be a good Coach's Corner.
Yeah.
So let's go and check out our Chalk Talk question for today. Now, for anybody who's new, we like to throw this in as a little thought puzzle here, which we'll answer at the end. Now, I know it's a little vague, actually a lot vague, but that's part of the idea. So let's say that say that you know that a stock will rise for sure. Now, of course, that's going to beg the question, how would you know that? Well, use your imagination. Maybe there's some type of inside information, not that we would ever trade on that, but just for a thought experiment. You pretty much know this is, if it's not 100% for sure, you're 99% sure.
Maybe you're the buyer of the stock, Bill.
Maybe you are the one that's going to be running it up. Exactly.
Yeah.
So the question is, which trade would you place? And this is just to get people to think a little bit deeper level about options, because we have a feeling we know how most people would answer this. So we want you to think about it for 5 or 10 seconds and jot down an answer. And we're going to come back and revisit that at the end. All right. So with that being said, what do you think our movie is here, Stu? Let's go take a look at Synthetics and Gordon Gekko, the Gordon Gekko fail. We've had conversations about this many times, and we said, if we understand why they probably didn't put it in the movie because it would have just confused people. But we were just thinking, if they really wanted to make it more realistic, it was a bad trade. It was a bad idea, or at least maybe not as good as it could have been. Might have been a better way to talk about it.
Yeah, maybe.
So the idea here is we want to show you a little bit about synthetic options, what they are, how to figure them out. And then we'll show you, by understanding synthetics, where this trade could have been a lot more polished. So we have for you today a little clip. I'm sure you all remember it, but let's listen here.
She's buying Anacott steel.
Okay. When the market opens tomorrow, I want you to buy 1,500 July 50 calls. You hear me?
1,500, yes, sir.
And start buying 1,000 share blocks and take up to $50. When it reaches 50, give out a little taste to your friends. Then I want you to call the Wall Street Chronicle, extension 1605. You tell the man Blue Horseshoe loves Anacott steel.
Blue Horseshoe loves Anacott steel. Okay, so the idea here, Stu, actually being a former market maker, could you give us a 15-second version? Because I know that some people who might not be well versed in the market, what was he really trying to do here?
Well, he was trying to front run his own orders. He was, he had an idea of some other person. It was actually that guy from England, right. Sir, I can't remember his name, they figured out that he was going to be buying the stock outright, just like today's merger with Splunk. He was going to be buying it. He didn't really know what price, but he figured out that he was going to be buying it. Gordon, my man Gordon, he kind of stepped in front of that whole idea and he started buying small pieces of stock and as well placed an order to buy 1,500 July 50 calls. The stock is currently in the, I believe it was around the mid 40s, 44, 45, somewhere in there.
Yeah. So he's trying to buy the stock up. And then when he made that comment about give a taste to your friends and call the Wall Street Chronicle, what was he doing there?
Well, he's trying to get more interest to pump up the stock, to get some more fervor going, to create more hype so the stock will go.
Exactly. So he's telling Bud, he says, give a taste to your friends. Hey, I got this inside tip here. So they'll start getting on the phones with their clients and start pushing this stock up. So we all know that Gordon Gekko was the quintessential market manipulator. And so one of the things that he did here was to buy the July 50 calls, 1,500 of them. Yeah. All right. So that's what we're going to talk about here. And the question that we've talked about, Stu, is this really the best trade? We actually think it's kind of the wrong trade. Now, again, in fairness, it's a movie. And we know that it's probably why they didn't put it in the movie, to thoroughly confuse people. But just between us, between the options traders and among us here, what could he have done that was better? Well, answer that.
Yeah, go ahead.
No, well, to answer that, this is why you have to understand options at a deeper level. And this is where a whole nother branch of options trading comes in called synthetic positions. Okay, we talk about these all the time in Q&A. So what's a synthetic position? Well, roughly speaking, it's just like with synthetic oil. Okay, it looks, acts, feels, behaves like the real stuff, but it's made from different ingredients. And that's what we're doing with synthetic positions. And so with synthetic positions, we're going to deal with stock, calls, and puts. And just understand that any one of these can be created by the remaining two. So we'll show you how here in just a second. And as always, for anybody who might be new, please visit us at marketrebellion.com/get started. A lot of great information to help you get started with options. So to figure out how these are done, how we would create the synthetic equivalents, there's a little formula. Now, don't shy away. We're going to show you an alternate view that's a little more visual, where you can kind of look at it or kind of picture it in your mind's eye and figure out what the synthetic should be. But we also want to show you a formula so you can definitely get the right answer. So it's called the put-call parity formula. And parity in the markets is just a fancy word that means equivalence. And so it's an equivalence. It's a way of showing in a kind of a weird connection between 100 shares of stock, calls, and puts, and how they are really all equivalent, or how we can equate one group to another. And one of the ways,
keep in mind that one contract delivers or obligates 100 shares of stock.
100 shares, correct. So the thing that you can do is look at long shares of stock plus a long put plus a short call. Now, one of the caveats...
Minus the call.
Yeah, but I said plus a short call. Same thing, right?
Oh, okay.
So, so you're short this call, and the idea of this is actually kind of a special trade. I know, Stu, you've done a bazillion of them on the floor, kind of a staple of market makers. It's called a conversion. And it actually locks up the trade and it makes it behave like a bond. Now, one of the caveats is that it has to have the same strikes for the call and the put.
And the same expiration.
And the same expiration, right. But so if you have the 100 put, we'd have to have the 100 call.
Right.
Now, in the real world, there are variations of strategies like this where that's not true. But for the conversion, it does have to be true.
And when Bill says the bond, really, what he's really talking about is just the cost of the money. Just what is the money? What is the value of the money? That's all he's saying here.
Yeah. So it's going to behave maybe like a bank CD. So you might pay $9,500 and it will mature to $10,000 in a year, something like that. Or you pay $975 and it matures to $1,000. It's that it's guaranteed to grow to a certain value. So that's what we mean by a bond.
Because it's a fixed interest rate.
It's a fixed interest rate, but even more importantly is that the combination of the calls and puts locks that in. And that's why it's kind of interesting when you hear people say that options are risky. This is a beautiful proof to show that is absolutely not true.
Takes away all the risk.
Exactly. In this case, it's completely shut it off.
Yeah.
So the better way to understand the options is that they hedge risk. We can turn it off. We can crank it up. There's no doubt we can crank it up. But you can also find any shade in between. And that's really what makes you a better trader or investor. So this is a little shortened version. Instead of thinking of bond, we can just replace it with a zero as a way to, in a roundabout way, let's say that it has no risk. It'll just make the algebra a little bit easier.
Yeah. Think of like a zero interest rate environment, which we were in for many years.
Yeah. So let's say, let's ask the question, what is a synthetic long call? All right. So we all know what a long call is. You go on your broker's platform, you click on call. But how could we create that synthetically? Remember, synthetic things like synthetic oil are made from different ingredients, but they look, act, feel, behave like something else. So what you're going to do here is take a look at this equation and say, what are we trying to figure out? It's a long call. Well, I don't have a long call over here, but I do have a minus call. And you probably remember from your high school algebra days, if you managed to stay awake in those, we can add C to both sides. Or I like to just kind of visualize it. If these are like little pieces of a puzzle, just put your finger on it and drag it to the right side of the equals. And when you do, you have to change the sign from minus to plus. Two different ways of getting the same answer. So let's do that. Let's isolate the C. When we do that, what do we have left? On the left-hand side, we have stock plus put equals a long call. So what this is telling us is that if you buy shares of stock and let's say $100 put, it's going to behave just as the same as if you had purchased 100 call. Now, when we say synthetic or behaves like, what we're talking about is the risk profile. So let's go see if that's true, Stu. Here's a long call. Here's a $50 call. There's our bend at 50. Limited risk.
At expiration.
At expiration. Thank you. Absolutely. So what do you suppose our risk graph looks like if we bought shares of stock 100 and bought the same strike put? We bought a 50 put. It's going to look like, look at that. Exactly the same thing.
Kind of looks like a mirror image.
Just a mirror image. So not only do they behave in terms of the profits and losses, but across the board, they will have the same deltas at the same moments in time, the same gamma, same vega, same theta. Everything is the same across the board. So there's two ways that we can think of it as a risk profile, as a strategy or a risk graph that you're trying to get. You could do it by buying a call, but you could also buy the stock, or maybe you already have the stock and then buy the same strike put. And you are doing exactly the same thing. Now, little footnote here, Stu. We've talked about this many times in our Q&A classes. Some people would say, well, wait a minute. They're not exactly the same because the stock plus the put is going to cost you more than just the call. And if you thought that, that's a very good observation. And this is where we're really taking a little bit of liberties with the explanation. There's really two different versions of put-call parity. And there's one that's called a mimicking portfolio and one that's called a replicating. This is the mimicking. And what it means is that If the call buyer buys his call and he's up $1, the stock plus put trader is up $1. Now, obviously, the size of the positions is different, but we're just trying to mirror the changes. So if the call buyer is down $3.17, the stock plus put buyer will be down $3.17, even though the total value of the position is bigger. So just in case you had that little flash go through the back of your mind going, wait a minute, these aren't the same. We're talking about the way they behave in the net changes, and they will be exactly the same. Okay, let's try another one. What's synthetic long stock? Well, one way we could get long stock is to buy shares of stock, but we could also do it synthetically. So Stu, what are we going to do here? We've got long stock already. And by the way, if we don't see a plus sign out here, it's just implied. We could write it there without any damage, but it's implied to be positive. So we've already got long stock out here, but now we have to get the call and the put away from it. Remember, we want to isolate stock by itself. So let's put our finger on the C, drag it over to this side, take the P, move it over. And when we do, we're going to
change the signs.
Very good. So that should give us long call minus put.
Yeah.
So
you can also move the equal sign over and change the signs, but
you could do that too. So what does that give us?
Here's the point, everyone. Right? You can create whatever you want using a put and a call, or using a stock and a call if you're looking for a put, or using a put and stock if you're looking for a call, or looking for stock. You can use a call and a put. Obligations and rights. It's always going to come back to that.
Yep. You've heard us say many times that calls are puts, puts are calls, and now you're seeing a little bit of the reason why.
This is kind of why,
yeah. Anything you can do with a call can be done with a put. It's just a matter of which side of the risk graph that you're looking at. So anyway, what it's telling us is that we have long shares of stock on the left, and it will behave just like if we had, let's say, a long 50 call and a short 50 put with the same expirations. So let's go see if that's true, Stu. It kind of looks weird. It doesn't look like it could be, because calls and puts, we're used to seeing those hockey stick graphs with the bends in them. So there's the long shares of stock. So if we buy the $50 call and sell the 50 put, look at that. We get exactly the same thing.
Yeah.
So we can replicate shares of stock. This would be the synthetic equivalent. Normally the two piece or the two asset piece is the synthetic. So we would say that a long call and a short put is the synthetic equivalent of long stock. And this is why they behave exactly the same. So again, stock traders up $1.34. What do you suppose this guy's going to be up down here? $1.34. All right. Now, again, the total value of the positions will be very different. But that's a different put call parity formula. We're talking
we're not really talking about that.
Yeah, but I just want to make that clear, just in case anybody's going, something's wrong, because this would cost you a lot more. And if you observe that, that would be true. But we're just talking about in the market, when we talk about synthetics, this is what we're referring to. We're not counting the bond. All right, so that's one way you can get the surefire answer, assuming you have a little bit of algebra skills there. But if not, there's another way, an alternate view, that you can come up with exactly the same answers. So one thing is to understand that your delta always comes from stock. So in those risk graphs, we see a 45-degree angled line either leaning to the right for a call or to the left for a put. That is coming from either shares of stock or shares of short stock. That's one thing to remember. Second thing is that the synthetic equivalent never includes the asset you're trying to replicate. All right. And then the third thing is that the option signs stay the same. So for example, if you're trying to create a long call, you know that part of the answer must be a long put. Remember, we can't have long call in the answer. That's what we're trying to create. But the signs will stay the same. So if it's a long call, you know it's a long, just flip it to the opposite option, long put. Another way of showing calls are puts, puts are calls. If you want to create a long...
And what are we missing on that right side of the equation to create that long call?
Exactly. All right, so what about a short call? Well, you should immediately know that it's going to include a short put.
Yeah, And again,
Right.
what are we missing? See, the third component here is
the
stock,
deltas.
right?
Right,
And that's
so
where the deltas come from. They come from the stock.
Yep. So again, just to put it in a different light, we've got stock calls and puts. You want to create a long call. What do you know? You know that part of the answer must be a long put. Or if you want to create a short call, you immediately know that part of the answer must be a short put. All right, that's going to handle the options part. Now, as Stu was saying, we've got to also now include the angled part of this line, the deltas. So here's our long stock. And if you notice, it kind of leans this way out. I usually call it the pointing to the northeast. And if you see that, it is a long stock position. If it goes in the other direction, out this way in the northwest corner, it would be a short stock position. So anytime you see a risk graph where the risk graph leans to the right like this, pointing in that northeast direction, part of the answer must be long shares of stock. That's the only place that those deltas are coming from. All right, so keep that in mind. Now let's go take a look at our synthetics again. Here's the long call that we started with before. If you don't want to use the algebra version, just look at this or picture it in your head. What's the first thing I'm going to notice? What kind of stock is that right there, Stu, leaning out to the right?
That's long stock. So, something I just kind of thought about here. So people might be thinking, well, if I don't have any, if I just have, if the deltas come from the stock, but I don't have a stock position, then would I have deltas? So the answer to that is yes, of course. Yeah. The puts and calls together in combination, or either even by themselves, they create a delta.
Right. Because you have the right to take the long stock or the short stock position.
That's right. Or you have an obligation if you're short to either sell the stock or buy the stock if it's under the strike. So they create these, like, I guess you could even call them like synthetic deltas in a way.
In a way, it is. Yeah. So if you're wondering, hey, wait a minute, I don't have long shares of stock with a call, you don't. But you have the right to buy shares of stock. And that is just as good as saying I've got a fixed price that's locked in. So when I say that they're coming from the long stock, as Stu said, don't think that that means that you actually have stock in the account or that you must buy it. Just owning the call, getting this risk graph, that angled line right there is coming from long stock. All right, so we got part of the puzzle solved, but now we're trying to figure out a long call. So did you remember what we need to do? We know it's a long. It's going to be matched with a long. The signs stay the same.
Yep.
But we're going to flip from call to put.
Yep.
So what does that tell you? Long stock and long put must be our long call. So there we go. Our long call, that's what we were trying to figure out, equals long stock, that's the deltas, plus the long put. Again, notice these signs are the same. If you're trying to figure out a long call, you immediately know part of the answer is a long put. So again, look how quick it is. If you picture this in your head, as soon as somebody says, what's a long call? Immediately just blurt out long put and then figure out where the deltas are coming from. Long put, long stock. Okay, so it's actually kind of an easy way to do it. So here's our short stock position that we talked about. Now it's leaning to the northwest corner. It profits from falling prices. If prices fall, we actually make money. If they rise, we lose money. So anytime we see any risk graph, not just a call or a put, well, actually all risk graphs are ultimately built by calls or puts, but I'm saying if you see a butterfly spread or something and you see part of that risk graph leaning that way, it is coming from short shares of stock. So now let's look at a long put. Let's try to figure this out visually. First thing I'm going to see, I've got those deltas. That's coming from short stock. So I know part of the answer must be short stock. I'm trying to figure out long put. So I know it's a long something. Signs stay the same. But we're trying to figure out put. So I can't use put in my answer. It must be a call. Why? Calls or puts, puts or calls. So we know that short stock, long call must be the long put. There we go. Long put equals short stock plus a long call. Notice again that the signs are the same. So those are some things that you can work with. Now, again, as Stu mentioned, you might say, well, how am I getting short shares of stock? Well, again, it's the right to short shares of stock. No, you don't have them in your account. But the fact that you have the right to exercise, if you don't own the shares of stock, you could exercise into a short stock position. And that's why you are getting negative deltas. All right, so let's keep these thoughts in mind and let's go check out Gordon Gekko here. But before we do, Again, please check out marketrebellion.com/get started for anybody who's new, or even if you're not brand new. We've got lots of great educational videos and materials to help you get started. All right, so back to our little puzzle here, Stu. Predicting the future. All right, now we know that at least these highly polished crystal balls aren't real easy to come across. And just when you think you did, Murphy's Law steps in. But this is the next best thing. So we want to think about this little cagey character here, Gordon Gekko, who's going to step in front of, his name escapes me. I've seen the movie so many times. Wasn't it Larry something?
Sir Larry Wildman.
Wildman, very good.
I don't know where
Look at that. I don't know where Larry came from. It just popped into my head, and you got Wildman. Okay, good teamwork. Yeah. But the point is that he was trying to he kind of inferred that this was happening. It was pretty much a sure deal. They'd done some digging and found he was going to was Philadelphia, right?
It was Pittsburgh.
Pittsburgh, and he was going to Pittsburgh, and they kind of inferred that he must be buying it up. So Gordon's going to go try to grab some shares, buy these 1,500 calls, and try to ride on his coattails. Mm-hmm. All right, so let's go take a look at that trade. So again, you have to put yourself in his shoes. You're Gordon Gekko. You pretty much know you're going to drive prices higher. Why would you buy the call options? Because if you look right here, what is causing that flat part of the line now that we've stepped through synthetics? Think about that for a moment. What is causing that to flatten out? Well, look at it synthetically. What is this? Deltas are coming from stock. That is coming from long put. So it's a stock plus put. Well, a put is just insurance. Why would you want to insure something that you know is going to happen?
So you have to ask yourself, do you really want the put part of this equation?
Exactly. Right. But see, people don't think that way, Stu. That's exactly what we're trying to show them. They go, oh, buy a call because it's cheaper than stock. And that's true, but we can make it even cheaper because we're going to get rid of the insurance. We're going to say, nope, I don't want it. And how do we do that?
Sell off the insurance.
We sell off the call. And now we've got long shares of stock. Sell off the put. And so what happens is that in the markets, the call might be trading for $20, but the put's probably trading for $19.80. So now you're getting in for 20 cents instead of $20. Mm-hmm. I mean, if you're really trying to get some leverage, why would you buy the insurance?
And you got to place yourself back in the moment. You know, if you're Gordon, like Bill said, you kind of know it's going up. One way you know it's going up is because you figured out that the other guy, Larry, is going to be buying it. The other way you know it's going up is because you're buying it.
Right. Yeah.
You're kind of front running your own. You're front running your own order.
Yeah. So a little bit like Nick Leeson trying to drive up the calls in the futures markets.
That didn't work out too well for him. But so these that's the setup. So if you're Gordon and you kind of know it's going up, you got to ask yourself, do I really want downside insurance? Because that's what the call really is, right? The call is really good. If things don't work out, the call goes to zero and that's the end of the day.
Right.
But do you need that? Do you want that? And what could be the alternative to make money on the way up?
Right.
When you're putting together this, this trade.
This was a massively better deal. And a little homework assignment for you out there. Try it. Pick a stock. Mm-hmm. Find, it doesn't even have to be at the money, but find an at the money something with some volatility to it, like Nvidia, anything that's got some
ARM.
Oh, that'd be a good one. ARM's got option. It's optionable. Check out ARM, ARM. But look at the at the monies. And look how much the call is by itself, and then look at the call minus the put. And that's a topic for another day, but we know it's just going to be the cost of carry. Now, we don't know how long away July was for Gordon Gekko, but we're going to assume it probably wasn't all that far into the future, which means the cost of carry would have been next to nothing.
Minimal.
So anyway, again, it was meant just to be fun. We know there could be all kinds of arguments about whether he should have kept the insurance or not. We just wanted you to think and to realize that if you really were in a situation like this,
I would be highly skeptical about buying the calls without selling the puts. So again, in fairness, I'm sure the movies, they might have figured that out, consulting with people and said, heck, that's going to confuse people. We just don't want you to be confused. So with that, one of my favorite quotes also from Mr. Gekko: money itself isn't lost or made. It's simply transferred from one perception to another. You talk about a deep philosophical quote, because that's very true. But we hope that we've now transferred a different perception to you about synthetics and options, and how you can become better when you really understand what makes them tick. So, Chalk Talk, a stock will rise for sure, or at least 99% for sure. Which trade do you place? I would make a very strong argument for the synthetic stock position, the call minus the put.
Yeah, and Bill and I really talked this through. We kind of went both ways. I've always felt like it was the wrong trade. He should have just went out and bought the stock, which he was doing in addition to buying the calls.
Correct. Yep.
And you can really make a discussion for the other side as well.
You can always do it. Exactly right.
It can go the other way. Is there ever really 100% certainty? No. In this case, you kind of have to assume that it's basically a certainty, but you don't really know which trade do you place. Maybe it just adds a little flavor. I think the movie it just added a little like sexiness to the, storyline. Hey, go buy some calls. It's like the floor of an exchange you're talking about. So there's a mystique about that. But, as far as option people go, did he really want, knowing Gordon from watching the character, I've seen that movie 75 times. Is he the kind of guy that really wants to buy the insurance?
Yeah.
And you have to say no.
Right. And for all of the options traders out there, as Stu said, sure, you could always make an argument for the other side and say, well, a million things could happen, or it's a terrorist attack, and now suddenly the whole market tanks. Who knows? Mm-hmm. Maybe you do want the insurance, and that's okay. Personal decisions, that's what makes a market, that's what makes traders. But you need to know which choices you have. And the bigger the menu is that you've got for the different choices in front of you, the better you're going to be. So when we started this, if you didn't see the synthetic stock as a choice, that's a good clue that you can become a lot better by understanding. And again, check us out, marketrebellion.com/get started, or maybe even might be able to get hooked up with somebody like Stu for some private coaching. But we at least hope that was fun and that you learned something from it. Stu, any final closing comments? Just
part of the choices that the options can really provide for you. You got to kind of think it through. Don't lock yourself in a corner. Is this the right trade for me? The answers come from what's my goal, right? You have to have a goal to start with. What's my goal? Let me formulate a goal. Now you're at point A and you're trying to get to point B. How am I going to get there? That's your strategy. See, that kind of narrows down a lot of what you're trying to question. How am I going to get from A to B? What are my different choices? What fits my risk tolerance?
Right. How much risk am I willing to take?
To my personal comfort level. And as always, when you choose your strategy, absolutely know what your risk is in the event it doesn't really work out. We are risk managers. We are not profit managers.
Couldn't have said it better. So again, we hope that helped. We want to wish everybody a great upcoming weekend. Hopefully, at least assuming you're bullish, that we get a little spark tomorrow, a little bounce, but we'll have to see. And if not, next week is always a new week. But we hope we gave you some good stuff to think about, and we'll look for you next Thursday on Coach's Corner at 4 p.m. Eastern Time. We'll see you then.
See ya.